Ever wondered what happens behind the scenes when you buy or sell a stock? What really happens in the stock exchange? And how do your investments make their way from your screen to the market? Hello everyone, welcome to Imarticus Learning, your one-stop shop for all things finance and investing. Today we are diving into a question that's on everyone's mind. How does the stock exchange actually work? Is it just a bunch of people shouting at screens like in the movies? Or is there something more to it? Spoiler alert, there's more. So grab your chai, sit back and let's break it down, Indian style. First things first, what exactly is a stock exchange? Imagine a giant digital marketplace where shares of companies are bought and sold every single day. In India, we have two major stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. Think of them like two huge shopping malls for stocks. Instead of buying shoes or groceries, people are buying ownership in companies like Reliance, Infosys and HDFC. These shares change hands between buyers and sellers. And here's the exciting part, it's all happening in real time. But unlike shopping for clothes, stock prices are constantly changing. These prices changes depend on a variety of factors, from what the company is doing, how well it's performing, to even what's happening globally. The stock exchange allows these trades to happen efficiently with transparency and at lightning speed. Alright, so how does the stock exchange really work? Let's break it down step by step. Step 1. Listing. So first, companies get listed on the stock exchange through an IPO or initial public offering. Think of this like a company's grand opening. It's their way of saying, hey, want to own a piece of our business? Now's your chance. During an IPO, shares are offered to the public for the first time. If you buy these shares, you're essentially becoming a part owner of that company. Step 2. Buying and selling. Once listed, the company's shares are traded openly on the exchange. You, me, and millions of other investors can buy or sell shares using a demat account. This is like shopping online, but instead of getting products delivered to your home, you're buying ownership in companies. Step 3. The middlemen, which are the brokers and stock exchange. So your order doesn't just magically appear on the stock exchange. Stockbrokers like Zerodha, Upstocks, Angel One, etc. act as intermediaries. When you place a buy or sell order, the broker relays that order to the stock exchange. The stock exchange then finds a match for your order. If you're buying, they find someone selling at the same price. If you're selling, they find someone ready to buy. All of this happens in just a few seconds. Step 4. Trade confirmation. So once your order is matched, the trade is confirmed. The exchange then updates the price of the stock based on that transaction. Congratulations, you now officially own those shares. Now, you might be wondering, why do stock prices fluctuate so much? 1 minute they are up, the next they are down. What's really going on? At its core, stock prices are driven by supply and demand. But that's just the beginning of the story. Let's dive deeper. Company performance. So when a company does well, posts strong earnings, launches a successful new product, or announces a bigger merger, the stock price usually goes up. On the other hand, if profit falls or there's bad news like legal trouble or scandals, the stock price may drop. Global and economic factors. Stock prices are also influenced by the broader economy. Changes in government policies, interest rates, inflation, and even geopolitical events can cause market fluctuations. For example, if there's news of a major war or a global recession, markets tend to react negatively, leading to price drops. Market sentiment. Sometimes stock prices move simply because of how investors feel about the market. Are they optimistic or fearful? If investors think the economy is strong, they might buy more, pushing prices up. If they are worried about a potential downturn, they might start selling, driving prices down. It's kind of like Shah Rukh Khan's movie on opening night. If the movie is expected to be a hit, tickets sell out and prices might soar. But if there's like a negative buzz, prices drop and theaters may offer discounts just to fill the seats. Let's take this a step further. Stock prices can also be affected by other major factors. Let's break them down. Number 1. Dividends. When companies make profits, they sometimes share a portion with their shareholders in the form of dividends. Companies with a strong history of paying dividends are often considered stable, which can increase demand for their shares, pushing the prices up. Number 2. Mergers and acquisitions. So if two companies merge or one acquires another, it can have a significant impact on their stock prices. Investors tend to react based on how they think the deal will affect the company's future performance. Number 3. New products or innovations. So when a company announces a breakthrough product or technology, it can create a lot of excitement, leading to a surge in its stock price. Think about companies like Apple or Tesla when they announce new products. It can make their stock prices jump. Number 4. External events. Major external events like natural disasters, elections, or even pandemics can have a big impact on stock prices. When there is uncertainty in the market, prices tend to drop as investors become cautious. Now let's talk about the key players who make the stock exchange tick. It's not just about buyers and sellers. There's a whole system working behind the scenes to keep things running smoothly. Number 1. Stockbrokers. As we mentioned earlier, brokers act as intermediaries. You need a broker to place your trades on the stock exchange. They also provide platforms that let you view prices, research stocks, and place orders. Number 2. SEBI, Securities and Exchange Board of India. SEBI is the regulator. It ensures that the market operates fairly and transparently, preventing fraud or market manipulation. Think of SEBI as the referee of the stock market. Number 3. Market makers. Market makers ensure that there's always enough liquidity in the market. If there aren't enough buyers or sellers for a particular stock, they step in to keep the market moving. Number 4. Clearing corporations. Once a trade is executed, clearing corporations settle the trade by ensuring the buyer receives the shares and the seller gets the money. The entire process takes place behind the scenes to guarantee smooth transactions. So why does any of this matter to you? Why should you care about the stock exchange? The stock market offers one of the best ways to grow your wealth over time. By investing in stocks, you're essentially putting your money to work. Over the long term, stocks tend to grow as companies expand, innovate, and increase profits. Plus, you're not just a spectator, you're part of the economic engine. Whether you're saving for retirement, a home, or even a dream vacation, the stock market is a great tool for building wealth. Okay, to sum it up, the stock exchange is a fast-paced, ever-evolving marketplace where you can buy, sell, and grow your wealth. And it's not as complicated as it might seem. Now that you know the basics, it's time to get involved and take your first step into the world of investing. If you enjoyed this video, make sure to give it a thumbs up, subscribe to the channel, and hit the bell icon for more easy-to-understand finance content. Got any questions? Drop them in the comments, and I'll be sure to answer them. Happy investing, everyone!